Well, we're going to do it, folks. Welcome back, everybody. My name is Rudy. You're watching Alpha Investments. Sorry, I'm still in my, I just got done doing some outside yard work, so I'm a little sweaty, messy, dirty here. But you know what? When you talk about debt, you get a little dirty. It's just part of life. So today, per the request of a lot of people, it's like I speak a different language without the visor. I mean, this thing is from the 80s. So, per the request of patrons and a lot of people in the other financial videos, I've been getting so many requests to do a real, Rudy, you talk about these bonds, these debts, these corporate this and that. Can you give me a real world example so we can follow instead of the generic information? So we're going to do that today. So a couple things I have to get out of the way since we're going to use a real world example today. Obviously, if you're interested in this kind of stuff, you need to seek a licensed financial advisor, not a homeless guy who dropped out of middle school and then I went back to elementary school, literally live in my parents' basement. I'm wearing a 1999 Family Guy shirt from high school when I saved all my money cutting lawns in the middle of the desert, and I talk about tacos. You seriously need to get a real financial advisor. This is an entertainment channel. Everything is make-believe and fake. So today we're going to use an actual Royal Caribbean or Royal Caribbean, depending how you want to pronounce it, different types of pronunciations. We're going to use the Royal Caribbean as an example today. This is an actual bond. The data was pulled on April 30th of 2020 at the end of April here. Again, I'm even going to put fancy overlays over my face so you guys can actually see an actual sheet of data. Everything in this video is public information. So we're going to go through it. So if I actually had a real job, I had a client who was interested in high yield debt, also known as junk bonds or just higher, riskier credit worthiness companies, and the client wanted to go over this particular issue of debt, this is the conversation we would have. So, first, just so everybody knows here, I'm going to put some little things over my face. You guys can look at it. So, first things first, this is a Royal Caribbean bond. I'm going to put something on my face now. So you guys can see this is actually on E-Trade. I pulled this information from E-Trade Financial, but again, you can use any, Vanguard, TD, Fidelity. You can use any brokerage firm you want. Obviously, as you can see in the top left, the QSIP, also known as the serial number of the bond, is 780153AG7. So again, you can actually run that search in the corporate, the bond screening databases of any online full brokerage firm. So yeah, next to the right of the QSIP, you have the credit rating, which is Baa3 for Moody's and a double B, two Bs from S&P. Next to that, to the right, you have the issue description, which is Royal Caribbean or Royal Caribbean Cruise Lines. And it says senior, looks like global note, 7.5% maturing in 27, which is 2027. Has some conditional calls. There's some history and some reports you can view. All the way to the right in the top right corner of the screen, you can actually see it shows coupon, 7.5% interest per year, and it shows the maturity date of October 15th, 2027. So back to my face. So now that you guys can see me again, pretty much I took the kind of the interesting information, which is, that's the name of the bond. Here's your coupon, and the bond is going to be, out in the public until October of 2027. According to that sheet, by the way, this bond actually came to the market on October 14th, 1997. So originally, this bond was created in 1997. So this is a 30-year bond that, again, 97, oh, wait, oh, yeah, I thought it was like, that's 30 years. God, late time flies. So this is a 30-year bond that's already existed. This bond's already been on the market for, goodness gracious. There's only, 7 years left of this bond. So it's been on the market almost 23 years, 22 years. The coupon of 7.5%, it does state they pay semi-annually, which is how most corporate debt is. So obviously this is a secondary market bond. This is not a primary offering. This is not a new issue piece of paper. This debt is you're purchasing from another investor, another institution, another brokerage firm. You're buying it off somebody else. Royal Caribbean, that's the first thing everyone needs to understand. When you go to the secondary bond market, all of these things you're seeing are from other people. The companies are not issuing, this is not new issue debt. So when you buy this, the company does not get if I buy $10,000 of this bond, Royal Caribbean does not get $10,000. You're taking this paper from another person, and remember, you don't get an actual bond in the mail, everybody. This operates on a system as we call book entry. In other words, everything is digitally, it's the same thing in like the equity markets. They don't mail you shares of stock anymore. Everything is digital book entry. There's no actual physical forms that are traded around on the equity or debt markets. I believe there are some companies, I know back in the day, like a lot of families would give their kids like 1 share of Disney. I don't know if you can still request it. I don't know if they still do that at all. You'd have to look into that. So that's the first thing. It's a very important thing to understand. Whenever you go to the bond market and you're looking at secondary offerings, this is crap. Whether you buy it or not, it's the company gets no additional funding. You're just moving things. It's a shell game. You're taking this piece of paper, this debt here, and you're moving it from account to account on who gets pretty much the interest payment. So pretty much if you guys watching own this bond, and I come to you and say, yeah, I like this. I'm going to take $10,000 of this. And you take it from your account and give it to me. On the day of the transaction, I start getting that accrued interest by the day. So that brings me to phase number 2, everybody. It's a 7.5% interest. Okay? Now, we're going to take, let's take a real example here, by the way. Let's take, so we're going to buy, if I buy a $10,000 bond, let's just put 10K. I have $10,000, okay? Well, right now, the current price of the bond, as you guys can see here, if you remember on the sheet, I guess I can put it back on the screen. I guess I might have to kind of put things on and off the screen here. Well, anyways, on that sheet, if you guys want to pause the video, it shows the bid. Actually, I'll write that here. You've got the bid and you've got the ask. You got the BA. No, not Bank of Amanda from the other video. Stop with the ex-girlfriends. I know some of you out there, you think this is all shenanigans. Well, you may be right. Okay, so we got the bid and the ask. We got the Bank of Amanda again. So again, if we're trying to buy something, we don't care about the bid. Well, all we care about is the ask, because we cannot get this price. That is pretty much, it's irrelevant when you're trying to buy a bond. Just remember, that's pretty much when you're selling, that's where the bids are. So we're not getting into that. So anyways, right now, if we want to buy this bond, the asking price of the market from other sellers is 79.744 or 79.74. Okay, usually people there's not really a need to go that many decimal places. So what a 79.74 or a 79.74 ask price means is that if I want to come to the market and I want to buy $10,000 in this cruise line, if I pretty much a $10,000 face value bond is going to cost me $7,974. And of course, the point, we're not going to get into detail. So overall, a $10,000 face value, this is face value, FV, okay? Not the actual, it's face value. That's the actual, because remember, bonds are traded in even $1,000 denominations for the notes. So on a face value of 10K, the E-Trade, Vanguard, Fidelity, whoever it is, the ask price is this. We're actually going to have to pony up $7,974. And what was it? I think it was 4, right? That I erased? Or let's say 40 cents. So the actual price for the 10,000 face value bond is actually going to be $7,900. Okay, well, that's kind of cool. So we'll have a little bit of money left from our $10,000, Bank of Timmy and Bank of ex-girlfriend Amanda, right? So not bad. So that's the actual cost of the bond for us to place it into our account from this person who's asking a $79.74 price point. So again, now if this number, by the way, just to give you guys an example, if this number was actually 100 or 99.99 or a full 100, if this number, and that happens many times, like if it's an Apple or a Google or the Alphabet Google or some sort of Microsoft or some sort of high-end company that has killer AAA credit rating, the bond price is probably going to be a full 100 cents on the dollar, which means $10,000 face value is going to cost you a full 10K. And actually, many times, if the company's doing really good, you're going to have to pay a premium. In other words, to take the bond from somebody else, you're going to have to give them extra money. Like that $10,000 bond, at the end of this 2027, Royal Caribbean's going to give you your $10,000 back. But if the company's doing so well, just to buy that bond, you may have to give somebody else 11, 12, or you may have to pay them an extra couple grand and take that couple grand as a loss just to get that paper because it's in such high demand. That happens a lot to very AAA, AA rated companies when, the interest rate environment and of course, what they call the flight to safety, if the yield curve and all this. Anyways, but overall, that's pretty much what you need to know. You need to know pretty much what the price that you need to pay is. So, just because they're paying 7.5%, this is where it gets tricky, everybody. This is where everybody needs to pay attention, kind of stay focused with it, okay? So think about this. So although the coupon is the actual amount that Royal Caribbean is going to pay you. Okay, so as we move to the second part of this video, this is the amount that the company has to actually cut a check for. So that's what they call, this is the actual amount that they need to service the debt. So that means that on a $10,000 face value bond, they have to pay 7.5% on the old chicken coop. So if this coop is 7.5 on 10K, how much is that? That's $750, everybody. So remember I told you at the beginning of this video, it pays semi-annual. So if the chicken coop is 7.5, that's going to be $750 a year. And of course, they split that up by 2 payments, which is going to be, what was that? Divided by 2, was that $375 every 6 months. Okay, so every 6 months, you're going to get $375 for holding a $10,000 piece of paper from Royal Caribbean. So, but now here's the interesting part. If you pay the ask price of $79.74 and we bought the bond for this price, remember, we own a $10,000 bond, but we only paid this. So we're still getting the full $750 on $10,000, even though we didn't pay $10,000. And that, ladies and gentlemen, is where your YTM comes in. That's called your yield to maturity. This is where the teeter-totter comes in. The lower this number is, the higher your YTM goes. The higher this number is, it's inverse. So if you got a teeter-totter, here's your pivot point, here's your triangle pivot. And if you have a teeter-totter, if the teeter-totter tilts versus the teeter-totter tilts the other way, it's going to dictate how it moves. So I know I'm kind of throwing a lot at you guys. This is like an entire finance course in like a 30-minute video. So I know, bear with me. It'll get more clear, I promise. So for example, if you're paying 79 cents on the dollar, 79 cents, obviously your yield is your coop, because it's tilted higher, is going to be higher. So you're going to have an 11.6% interest rate. If the teeter-totter inverses and you end up have to pay 110 cents on the dollar, your yield is going to tank from 11.6 back to 7.5 and go even lower to 5%. So the teeter-totter of the price you pay versus your yield are always inversely related. And it's, and again, I don't expect everybody to kind of memorize this, but I'm just trying to explain to you, this is how behind the scenes information works if you're going to discuss this with a client or go over details, and you better know what the hell you're talking about. I'm going to be very blunt with everybody. The average financial advisor, and no disrespect to any particular company, I'm not going to name names of any firms, or let's just put it this way. If you go to your local bank and they have that little person sitting in the cubicle, or the little person sitting in the room saying advisor or investment services, they got a little room or something, I can pretty much almost guarantee you with a 99% certainty that most of those people are not going to know anything about this stuff. They're going to tell you to buy a mutual fund and go away, which is fine. There's nothing wrong with that. Most pretty much regular branch or local advisors are not going to have the in-depth knowledge to handle specific things in the debt markets. Remember that. Remember, people try to get rich in the stock market, but wealth is usually created in the debt markets. And this is not normal things that usually regular individuals deal with, unless you're dealing with what I like to call a 7 or 8 figure bank account, which is going to be at 1 million plus. Usually these type of individual debt holdings are done in 10 million plus asset accounts or clients with very large amounts, because then you can split it up and buy a bunch of blocks. Unrelated, a fun little tip with everybody, in the bond market, in the stock market, in the equity world, 100 share purchase is considered a block of shares. So if you want 100 shares of Amazon, what's a good example? 100 shares of some Google or Tesla or whatever you're into, I don't know. Usually 100 shares are considered even blocks. In the debt market, $10,000 bonds, or what they call 10 bonds. Each bond is denominated usually in 1K. So 10 bonds is deemed as a block. So like institutional traders will refer to each other, how many blocks do you have? Hey, Rudy, how many blocks of Royal Caribbean do you have? And if I say, well, I got 2 blocks, that means I have 20,000 face value in Royal Caribbean. So that would be how that kind of data functions, just so everybody knows. Interesting stuff. I love this stuff. As you can see, I've spent a tremendous amount of time of my life, monitoring and learning and mastering and trying to really get good at this trade in my past. Unfortunately, now that I'm in my mid-30s, I really don't use a lot of this stuff anymore, but I still have a huge appreciation for how the industry works. So I think it's a really cool thing. So, summarize where we're at, everybody. We got the bond. That's the coupon, which is what the company has to pay us to service the debt. If they don't pay that, this credit rating goes to an immediate double D's. Not D's nuts, not double D's like all you creepy little dudes out there like creepy Rudy. Not double, no. Double D's means default. If they can't service the debt, the credit rating will, no matter if they're AAA rated, they go straight to default. Or conditional default or all these other weird things. So that's what that is. This is the end of the bond. Just because this bond was issued in 1997 and it ends in 30 years in 2027 doesn't mean you have to buy at the beginning or the end. I actually knew some individual traders and investors that would actually buy bonds right before maturities. They would actually try to time things. They would look for companies that were distressed and they'd be real cheap. Like instead of 79 cents on the dollar, they'd be like 30, 40 cents on the dollar. And they would try to buy them within 12 months of maturity. And they would research the company to see if they're going to be able to refinance or roll over the debt and to try to make a quick capital gain from paying a discount to getting the full value back. Well, I knew people that were involved in that kind of stuff. That was never my personal thing because I just didn't like that risk level. So anyways, moving on to this, like I said, another important aspect for everybody to learn in this video is, again, the price you pay, the coupon rate, these two numbers teeter-totter what your actual rate of return, what your IRR, internal rate of return, your YTM for yield to maturity. Some people call it YTW for yield to worst. There's a lot of acronyms and fancy crap that smart people want to act like they're all cool. I don't really care about that. Pretty much the important thing is how much do they have to pay to service? What can you buy the asset for? How long is it going to be for? And of course, based on the price you're paying, what is your actual yield? Not what the coupon is. What is the actual yield to worst, yield to maturity? What am I going to get based on today's price? I don't care about this. I don't care. What am I actually going to get? That's what you need to understand. Now, we're going to get into some little side things here, little side tidbits to teach you guys some fascinating things. When you deal with a company, actually, this is a good one. When you deal with like Royal Caribbean, it's a cruise line. Corona crash 2020. Everything sucks. We know it. But we know things are going to survive. Things are going to get better. What we don't know, are they going to be able to continue to service the debt? Are they going to be? Do they have to raise more money? Probably. Are they going to get a bailout from the government? Because that's how this country works now. Probably not. I don't know. Depends how the government and the cruise lines get along. I don't know. So what you need to understand is, number one, we're not talking about stocks. And this is going to click for some of you out there. This is one of the reasons I'm not a big equity fan. I don't like stocks as much as bonds. Because most likely, if the company has to raise money, they do it by one of two ways. They issue additional bonds, take the money, and pay the other bonds. Kind of a Ponzi scheme thing. Or B, what most companies do is they're going to issue more stock. They do what they call equity dilution. When they take that route, the bonds tend to rally and the stock tends to go down because it's diluting. All you're doing is adding more shares of your company, making the shares worth less. Now that usually is good for bondholders, bad for stockholders. So another reason companies like to issue more stock is because, remember, by issuing stock, you don't have to pay more of that 7.5% chicken coop. Usually stock, maybe there's a dividend, maybe they cut the dividend, I don't know. So when you consider all these things together, you have to really analyze, okay, this maturity is nowhere near. That's good. You don't want turbulent times. You don't want your debt to be approaching maturity during bad times like this. That is a no-go. That is a bad, negative Nancy, Debbie Downer, Timmy the Taco. You do not want this bond to be maturing in 3 months in the middle of a Corona crash 2020. You don't want that. That's bad. That means that you're going to have a hard time getting new debt to roll it over. You're probably going to have to increase this on a new bond and actually pay even more on the old chicken coop. You're going to have to raise all your costs because your timing is bad. That sucks. So you always have to pay attention to when that actual date is going to be, because this may end up increasing because they may not be able to get that kind of financing in a recession right now. Who's going to finance a cruise line when they're closed? So yeah, so that's something you have to consider, and that's the most important thing to think about by maturities and expiration dates. When you get your full $10,000 back. Yeah, but Rudy, I don't care. I only paid $7,900. I know that. But if they can't refinance or pay it in full, they're not going to be able to pay this in full. They'll have to roll it over and issue new bonds. Well, how are they going to issue new bonds in a market where they have no revenue and everything's shut down? So which means anyone who's going to be willing to buy new bonds, they're probably going to have to raise the rates. It's going to be a disaster. Now, next thing you need to understand, even though you get 11.6% interest or yield annually every year until the end of the expiration date, the company is still paying this. So I'm going to go back I'm going to pop this back on the screen. I guess I can put this back on the screen if we need to. So to look back at this original screen here, if you look right in the middle of the screen right now, you'll see type, you see corporate, transportation. It's not a new issue. It's by Royal Caribbean. It says listed. It has a little Y. See the Y there in the middle of the page? Right dead center on your screen, Y. That Y means yes, it is listed on the exchange under the symbol RCL, which is Royal Caribbean, so it is traded, there is stock. Is it a religious organization? No. That would be interesting if there's religious cruise lines. That'd be kind of strange. But on the left side of the screen, when we talked about when the bond came out in 1997, when it matures, blah, blah, blah. If you go down further, it tells you the size of the bond. So we see $300 million. Do you guys see that on the left there? The left middle. $300 million. And then below that, you see 1,000 times 1,000. You see that? That's the denominations in increment size. So which is an interesting thing. So that tells me, hey, you only need $1,000 to buy one bond, which is good. It's kind of broken up in smaller denominations for lower net worth individuals if they actually want a piece of this. Moving down further, everybody, you're going to remember this. Notice the Baa3 credit rating, effective March 31st. What do you guys notice about below that? Negative credit watch. Neg. You see the NEG for the neg? Neg effective 3/31. Whenever you see the NEG, the old neg there, that negative credit watch is a no-go. That's a bad thing. So, back to, you guys can look at my face again. I'm still here. So what we just learned from looking at that is, number one, this bond, there's $300 million worth. So this bond has $300 million in existence. That's how many bonds. So the company is paying 7.5% to service this $300 million bond. Now I can tell you guys just from my past 10 years ago, you're saying, well, Rudy, what the heck did they do with $300 million and why can't they pay it back? Cruise lines issue these bonds for $300 million because they usually use that, and they use that to build a new ship. And this was issued in 1997 when they were probably building additional ships to expand their fleet for around the world and more, vacations, tourists, and all this stuff out there. That's very common. Cruise lines, Carnivals, Royal Caribbeans, Norwegians, all this stuff. In Florida, Europe, around the world, Asia, Asian continents, they have a lot of different sectors, Princess Cruise Lines. And they float these giant bonds. And when they float these big bonds, that's how they pay for the ships. That's how they build them. So remember, Royal Caribbean is paying 7.5% on $300 million. Well, that's easy math. 10% of $300 million is $30 million. 5% is $15 million. Okay, so what's in the middle between $15 million and $30 million? Well, $22.5 million. So they're paying around $22 million a year just to service in interest. They're paying $22 million a year in interest just to service the debt. And they're not even paying it off. So either they're completely insane, or B, they know, the people who designed this, they know at the higher corporate ivory towers at Royal Caribbean, they know that they can make more than 7.5% on the money, which is the reason this bond exists. Because when they ran the numbers, issuing $300 million in debts, paying $22 million a year in interest over 30 years, oh my God. First of all, what is that? It's like $600 million in interest. That's like, so they're going to pay, is that really $600 million in interest? That's double the principal. Friendly reminder for those of you out there with mortgages paying minimum payments. Think about what I just said. They're going to pay $600 million in interest over 30 years for $300 million. Really? Really? Okay. That's insane. God, that's insane. Okay. But obviously the higher ups realize that, they're going to be able to make a lot more money then the interest to service that, because they know that ship they build is going to generate tremendous cash flow between the alcohol, the casinos, all the events, the gratuity, just the whole business model of the cruise line industry. They're probably going to make double to triple that. So while they're paying $22 million a year in interest to service the borrowed $300 million that built that big boat, chances are they're probably going to make like $50 million a year on that one boat. Well, I don't know about you guys, but if I make $50 million a year and I'm only paying $22 million on the borrowed money, I'm still making almost $30 million a year on one boat. And I got a fleet of 40 cruise lines. You guys see where all the money comes in. You can start to piece it together. So while on the surface the numbers look crazy and big and scary, it's important to understand how it actually breaks down, why they made those decisions, where the money goes, and how to look at these different categories. So, all right, so that's going to bring me to the next thing here, folks. So let's go back to the screen. I won't make you guys look at my funny face. Next, we're going to look at right here. Which one should we go to next? Where are we? 25, 30 minutes in the video. All right, so let's look at this order screen. So I'm going to pop up an order screen over my face. You guys can't see me right now. So on this order screen, this was pulled from E-Trade Financial. I'm not sponsored endorsing them. I'm just letting you guys know I just pulled it from there. Use any broker you want. I don't really care. This is an order screen here. It shows on the top left, it's a buy order. It has the QSIP, which is the serial number of the bond. Has the name of the company, Royal Caribbean Cruise Lines. It does have conditional calls. I don't want to get into that, but that pretty much means, there are events that can affect the bond, but I don't want to get into that. Now, below that, you see quantity. You guys see that empty box there? Well, that quantity shows a blank box with 3 zeros, and then next to it, it shows minimum 1, maximum 497. So for those of you not familiar with this, that actually means that anyone out there are currently 497 bonds available in the market, and you can buy a minimum of 1 and a maximum of 497. So that means any individual person can buy 1 bond, or you can buy up to 500 bonds almost. And a current price right below that, you guys see that? Price, $79.45 is the offer price. So that's $7,945. Or if you want to do minimum 1 bond would be $794.50. So you can do 1 bond for $794, or you can buy almost 500 bonds for almost $500,000. So that is the amount of bonds that are available from other investors, not from the cruise line company. These are from other people around the world. Okay, and of course, execution type, that just means the type of order. Fill or kill means either accept or reject your order. I know it's kind of dramatic sounding. On the right side of the screen, you guys can see, I did black out, obviously. I don't want you guys to see my balance in the account, my account number, so I had to black out a few things. You can see a few recent trade histories of other people who are buying. So overall, you can see all the way to the right, there's type. You see DLR to DLR, customer bought, so it's dealer to dealer, customer bought, dealer to dealer, customer bought, customer sold. You guys see that on the right side of the screen there? That just pretty much shows what kind of transactions, and it's interesting because you can look at that and you can see the other orders that people are doing. And of course, it has the details below that, bond details, the name, coupon, all that fun crap. All right, so back to looking at my face. Hello, welcome back, everybody. So overall, what we can take, so as you can see, what's interesting is there's almost 500 of these $1,000 bonds in the market. That's actually a pretty good size. That's actually a good amount. That's not insanely high, but if there's 300 million of this one particular bond in existence, well, 300 million, there's only 500,000 available. So that's 299.5 million people are holding in other accounts and they don't want to sell. So that means, 1% of 300 million is how much? It's $3 million. So, my God, that's like, what is that? A third of 1% of the bonds are available? That's pretty nice. Okay, so over 99.5% of these bonds people are still holding them. That's interesting to think about. So I wanted to share that. I thought that was interesting. That's what an order screen looks like. That's kind of how you go about doing this. Again, all brokerage firms are going to be slightly different on the details, but it gives you at least a good idea of what you can look for and kind of how to read it. So as we get to the last chunk of this video, I'm going to go over, I want to show you a few other neat little things, everybody, that you guys might find interesting. So first, we're going to talk about overall, okay, so we went on through all this stuff. We're at the end of the video. The client says, Rudy, okay, you've explained all this crazy crap to me. So Dr. Timmy's taco stand wants to know, Rudy, do I invest in this or not? What do we do? Is this a good investment or not? Okay, well, that's going to depend on if the client is looking, because remember, this is negative credit watch, which means that credit rating right here, remember this? This has remember the NEG for negative credit watch is a no-no. Anytime you see negative credit watch in any credit rating, and that was through, what was that, Moody's or S&P, something like that. The NEG means the credit score is useless. Whenever you see that, that is completely, it doesn't mean anything. You can't even consider that because you don't know how much they're gonna cut that credit rating. And once you see the negative credit, when they stamp that, all bets go out the window. So that's important to know. So now, before we make any decisions, let's take a look at one last screen here, everybody. So you guys can't see my face, so here we go. So let's take a look here. So this is the trade screen. So today, on April 30th, 2020, this bond, these are all the recent transactions from this morning. So that's interesting. Okay, so let's take a look here. We got some high trades, low trades. Let's look at the bottom. Let's look at the bottom of this. We'll start at the very bottom, 18 total trades, way at the bottom left corner. So 18 transactions this morning. Look at the times, 8:09 a.m., 8:59 a.m., 9:15 a.m., 9:15 a.m. But here's the interesting, this is what really caught my attention here. So look at the quantity right to the right of the trades at 10:45 a.m. on April 30th. Do you guys see that? 1,000 bonds. And the transaction happened twice. They broke the transaction into two transactions. And the fact it was the same time, that was probably the same broker making the same transaction for one client. So somebody dumped $1 million worth twice. That's a $2 million bond dump at 10:45 a.m. for about 78 to 79 cents on the dollar. And it shows to the right, both of those were customer sells. So chances are that was the same individual based on the timestamp. So wow, somebody just unloaded a huge position. Why? We have no idea. I thought that was interesting, but always remember. So let's go back to my face. Hello. Always remember a couple things. When you look at inside trading, inside selling, whether it comes to stocks or bonds, equities or debt, sell orders are more foggy than buy orders. So as we wrap up this video here, I want to leave you guys with a very, how do I say this? And again, for those of you who stick around 30 minutes in these videos, this is going to be the most important moment of this video. If you can take anything away from all these numbers and crazy Rudy's brain, forget all that for a second. I'm going to stand in front of it. Let me explain something to everybody. And this applies to Magic the Gathering, collectibles, any form of assets in the world. If you come to me and you want to sell $1 million in a bond, I don't know why you're selling. Maybe you're going through a divorce. Maybe your 3 different wives found out there's other wives. Maybe your girlfriend found out about your wife. Maybe your boyfriend found out about your husband. Maybe something bad happened and you have to raise money. And you're selling or liquidating that asset. And it has nothing to do with how you feel about the investment. You're liquidating because you need the money. So on the other side of the coin, maybe they're selling because they know something that we don't know and something bad's going to happen. Maybe they have inside info on Royal Caribbean. Maybe they simply they know they're going to go bankrupt. We don't know. So what I'm getting at is when you see a sell order in Magic the Gathering, when people sell me their collections, when you see a sell order on a corporate piece of paper, you never know why they're selling. It could be centric to the individual's private life and have nothing to do with the company, or it could be related to the company, or it could be related to their own medical bills or divorces, or they found out that they've got 45 kids with 47 different women. Anyways, so what I'm getting at is you can never, ever take selling seriously. So let me apply this to Magic real quick. When you sell a rare Magic collection to Channel Snowball's Kingdom Castles, and that company pays you $20,000, that doesn't mean the person believes Magic's going to zero. It doesn't mean the person wants nothing to do with Magic ever again. It doesn't mean Magic hit a top and Magic's going to tank and collapse. You cannot use or come to any or jump to conclusions, like they say in Office Space. You can't jump to any conclusions when people sell. That is what they call a noisy market indicator. It is a loosey-goosey, useless indicator to use. Now, again, selling is never beneficial for the company. When you see insiders selling or someone unloading their bonds, it's never a positive thing, but it may not be a negative thing. It gets into the economics and psychological understanding of how things work. It gets a little more complex, but I'm going to keep it real simple here as we wrap this up. So remember that when someone sells a Magic collection, it doesn't mean because the market's going to zero and they don't want Magic. It could just be personal reasons. They need money. Maybe they want to buy a house. Maybe they're getting divorced. Maybe they lost their job. Maybe something bad happened. Maybe a big opportunity to buy something else came up. You don't really know. Now, the final leg down in this video, the third leg, it's always right between the two little legs, the big third leg in the middle. Giggity. When you see buy orders are very cut and dry and very concise, very, very firm, as they say. When somebody buys, like me, a ton of reserve list cards, I get it all the time, emails, Rudy, you're like the only crazy person that's continuously buying reserve list cards, even sealed boxes. You're staying the course, and everything around you's on fire. The world's a disaster, and you don't care. You will not budge. Why? That's a very firm market indicator. Because why? Not because I'm trying to get anybody else to do it. I don't really care. Honestly, what people don't understand, when you guys see me buying things, I hope you think I'm manipulating the market, and I hope you believe that that's what I'm doing, even though it's not. But I hope you believe that, because then you won't buy into it. And if you don't buy anything, it helps keep the prices lower, and that's good for me. So people don't have the ability to play the 3D chess. They don't have the in-depth knowledge and just the psyche to really understand things. So when you see someone buying a huge order of Royal Caribbean bonds or inside buying on a particular company stock, that is a very bullish indicator, because people only buy for one reason. They want the asset. That's it. There's no other. It's not like the sell side, which is what they call market noise for multiple possible reasons. When people buy, the buy side of inside trading, whether it's company stock, people buying the bonds, buying debt, buying Magic, whatever it is, they're only buying for one reason. They want the asset. They want it. There's no other ways to spin it around. The person selling, like I said, they could be getting divorced. Maybe they're buying a Ferrari. Maybe they're buying the Rari. Maybe they're buying the Lambo. Maybe they just want to live their life and go party in Miami or something. I don't know. But I can tell you one thing. The person who's buying the bond, buying a house, buying sealed Magic, they're buying it for only one reason. They want the asset. So the biggest thing everyone needs to understand is when you look at the buy and sell, or the bid and the ask, like we talked about earlier, Bank of Amanda, bid and ask, the people who are buying only buy for one reason, but the people who are selling, you cannot use that as valid. There's no validity to that data. There's no credibility. It means nothing. And that is the most important thing to learn and understand about everything from watching my videos. Maybe, there's Rudy. He's really buying Amma and Ket now? Why is he buying Amma and Ket? He bashed that set for years. Now he's going back and he says he's buying it for a higher price. Yeah, I am. And I'm an idiot because I missed out on buying it for, I was selling that to patrons for $79. I was buying it for $76 back in the day. That was years ago before the price increase. And, now I'm paying $90 to $100 just to even get my hands on it. 30% higher because I missed out and I was emotional. So again, that is so imperative to learn the behavior behind the difference of buying and selling. That's such an important thing. So that's all I have today, folks. I hope you all learned something. This is probably going to be the first and only video on this channel using a specific example of an actual asset on the market. Final closure, because people are going to ask, so Rudy, what would you advise the client? I would advise the client that if he wants to build a high yield, riskier portfolio with companies that are going through stressful things or under duress, this would be a good piece to go inside of that puzzle. I would, if this client has $20 million and he wants to take $2 million, $10